All right. So, hi guys. Thank you for joining us tonight for the first quarter 2022 market review and the portfolio updates. My name is Jason, and I'd like to welcome you guys and thank you for your time. Okay, so without further ado, let me just intro myself. Right. My name is Jason, and I'm actually a wealth advisor here at Syfe. I speak mostly with customers nowadays. And prior to joining Syfe, I've been here for 6 years in the precious metals industry. Right. Today, I'd like to welcome Grace. I'm sure she's a very familiar face with everyone. So she's responsible for investment research at Syfe, right? And before this, she was actually at Franklin Templeton, right? We also have Ritesh, who's I'm sure you guys know him as well. He's the head of advisory here at Syfe, right? And without further ado, let me just hand over the time to Grace and Ritesh. Grace and Ritesh, please.
All right, thank you, Jason. Hey, yeah, so just want to introduce Syfe for a bit before we go into the topic. So at Syfe, we believe in giving you the tools and the platform that enables you to create a holistic wealth solution to meet your investment needs and goals. So we have Syfe Wealth for a more hands-off approach. So we're talking a lot about Syfe Wealth today, but we also have Syfe Trade for users who want to be more self-directed. So next is, safety is our number one priority. So keeping your assets safe is our top priority. One of the most common questions we get from customers is how are assets kept safe? So we are fully regulated by the MAS, and cash is kept in segregated accounts with DBS and HSBC, and investment assets, they're held in custody with partners like Saxo, Citi, and HSBC. So this is important to note because this means that if anything unforeseen happens to Syfe, you will still be able to access your assets and they will not be touched. So as we go on to the next section, so we'll cover investor concerns. So these are some top of mind concerns on the next page. So we'll cover like market review, how the markets have done on a year-to-date period. It hasn't been that easy for most investors. If the S&P, dipping into correction territories, losing more than 10% from its peak, and with Nasdaq entering a bear market, so losing 20% from its peak before staging a recovery more recently. And then coupled with the liftoff from the Federal Reserve, the highest inflation we've seen since 1982. Which are caused by supply side factors, but also exacerbated by the Russia-Ukraine war, a slowdown in China due to the latest COVID-19 wave, and a rise in stagflationary risk. So we want to talk about some of these key investor concerns, but before we start, we would like to ask a few poll questions. All right, so the first question is, which of the following factors are you most concerned about? So we have stagflation, geopolitical tensions, interest rate hikes, climate crisis, and the last one being recurring global health pandemic. Okay, I think we can somewhat say quite convincingly that at least for the top concern, it is stagflation. Yeah, we can revisit this as more people stream in, but we will be covering, stagflationary risks, as well as some other sort of growth concerns along with inflation in the next few slides. Okay, if we can move on. Yeah, thank you, Jason. Yeah, so on the next slide, and over the next few slides, we would just go over how equity markets have done, as well as some of the concerns like stagflation, quantitative tightening, and inflation. Jason, next slide, please. All right, so this is the trend line of major equity markets. So you have the S&P, the Dow Jones, Nasdaq, and then MSCI China since the start of the year, right? So we see that there has been a bit of recent recovery in the equity markets, and that came as investors realized that the worst case scenario for the economy has not materialized. So companies and households are entering this next stage of the economic cycle with tightening, but they are doing so at a pretty good sort of fundamental situation, right? So they have households and companies have decently strong balance sheets. They've built up savings over the pandemic, and there are risks to the horizon that we'll go over in the next few slides. So the first one, Jason, next slide, please, is stagflation, right? So stagflation, generally, it means that there's low growth and in some cases no growth, coupled with high inflation. And then as we sort of that effect flows through, you also see high unemployment. So in this chart, plotted inflation and unemployment. So I think it's quite undeniable that we have high inflation, right? Inflation as measured by the consumer price index hit 8.5% in March, and that's the highest since 1980s. Besides rising energy prices, which were made worse with the Russia-Ukraine war, in the US, that's also been elevated housing costs and rising wage inflation. So it is perhaps unlikely that we'll see this abate in the next few months, but longer term, as we head into like the end of 2022, most economists expect inflation to be lower than it is now. On the jobs front, so the US economy added about, sorry, previous slide, Jason, yeah, about 430,000 jobs in March. So this is a very strong showing. So that's the red line. You see that it's kind of around the same range as before we entered into the pandemic, so around like late 2019. And besides that, this means that unemployment rate is now about 3.8%, just a bit higher than the lowest it's been at 3.6%. US job vacancies moved back to the highest level in the latest reading, right, reflecting labor market tightness. We still see a high quits rate and a high vacancy rate, and job switchers being able to command a higher wage. So fears of stagflation still linger, even though most economic data points are still flashing green, and in some cases amber. So labor market, most of the indicators are green. Mortgage application rates, we're going to see that come down a bit, mostly due to higher cost of borrowing. So that's sort of amber, but then household and company balance sheets, that's still mostly green. So while we think that growth may be held back by persistent inflationary pressures in the short term, at least, these pressures are expected to abate towards the end of the year. And next, I think very important and on a lot of people's minds are how is the Fed going to fight inflation? Right? So right now we have what we people have coined quantitative tightening, which is the opposite of QE, which is quantitative easing. And in the last FOMC meeting, so these are the people who decide what the rate will be. Many on the committee have decided to are prepared to shrink the balance sheet and raise interest rates more aggressively to rein in inflation, but they were held back from doing so in the last meeting due to uncertainty over Russia's invasion of Ukraine. But now the plan is besides having the rate hikes, which are we are planning for 6, or we see plans for 6 more. There's also a plan to reduce the balance sheet, which is about 9 trillion currently. So the expected rate is about 60 billion monthly for treasuries and about 35 billion for mortgage-backed securities. So this rate is twice that of 2016 to 2019, to the last time that they did this. So raising interest rates and shrinking the balance sheet, so what effect would it have on inflation and economic growth, right? So this, by increasing the cost of borrowing, this eventually leads to perhaps slower growth, right? People and businesses are less likely to consume, or sort of maybe they might delay expansion or sort of plan a smaller expansion or sort of hiring plans. And this would dampen the economic activity and eventually lower prices. So this chain reaction tends to take some time, but if prices remain high and consumers expect persistently high prices, then controlling inflation in that scenario will be even more difficult. Next, we have geopolitical tensions. So this chart shows a few key commodities that have surged post Russia's invasion of Ukraine, and which happened around the middle of February. But you see that even before that, you really see some of that prices go up. I think that for the commodity that increased the most, that has been natural gas. So that has increased about 80% since the start of the year. Oil has gained about 40%, and gold has gained about 9%. And the next point, the next slide is on yield curve inversion. So we've heard quite a bit about this in the last few weeks because we have seen occasional yield curve inversion. So the yield curve is, essentially the difference between interest rates on the shorter term. So, like 3 months, 2 years versus longer terms, like 10 years and further out. So typically when an economy is in good health, the rate on the longer term bonds, that would be longer, right? Because if you think you're taking out a mortgage, if you're thinking of like borrowing, if you do it for a longer period of time, right, that's more uncertainty then versus like a shorter time. So the extra interest rate is to compensate in part for the risk that strong economic growth would set off a broad rise in prices, inflation, in other words. But lately, we've seen the yield curve begin to flatten. So this means that the differential between the 2-year and the 10-year has narrowed, and occasionally it has inverted. And many investors will be aware that for every recession in the last 60 years, that has been preceded by an inverted yield curve. But however, not every yield curve inversion has correctly signaled a recession. And there have been false positives in the 60s and in 2019. So in that case, it's because the global pandemic rather than an economic slowdown caused by or preceding a yield curve inversion. However, I think it's important to point out that even if there are blips where the yield curve inverts, generally it has to happen for a prolonged period of time. So according to research from this economist called Campbell Harvey, who studies yield curves, it has to happen for at least a calendar quarter before it can be regarded as a signal for impending recession. And along with, since the global financial crisis, with the Fed's involvement in the U.S. Treasury market, and that causing subsequent distortions, yield curve inversion may not be as reliable an indicator and as a predictor for the next recession. But there are, concerns about growth that we'll see in the next page. So this is the latest World Economic Outlook published by the IMF. So global economic prospects have been set back. It's still all green now, but as compared to the last publication in January, the growth estimates have been revised downwards and consumer prices have been revised upwards. And this, so before the war, inflation in many countries were already rising due to supply-demand imbalances and policy support. But then with the recent lockdown in China, as well as this high inflation and like growth revisions downwards, with EU being the second largest contributor besides Russia, right? Globally, we see that everything has sort of been like pulled downwards. But looking at these indicators, right? I mean, looking at the world output for 2022 and 2023, it's still 3.6%. So this is total world GDP from all the countries, and that's not too bad, right? It's still positive compared to like longer term growth. Which is tend to around 4%. It's still close to that, even though it has been lower as compared to 2021, which because of what happened in 2020. So like on the year-on-year basis, it seems like a lot higher. Yeah, and I think something that's quite interesting to note is that inflation is projected by the IMF to peak in 2022 before falling next year. And I shared earlier, because with some of the commodity prices like wheat and agricultural commodities, many emerging and developing markets are expected to bear the brunt of this rise in prices. And that shows up through higher inflation and lower GDP in 2022 before recovering in 2023. And on the line, the last one of GDP, it's China. So 2022, if we can go to the next slide too, Jason. The China GDP is expected to grow at 4.4%, right? So this is below their target of about 5.5%. But I think don't count China out yet. Out of all the major economies and central banks, China's PBOC is currently one of the most dovish. So compared to some like the US in this chart, right, China's starting off at a higher base and has resisted cutting its loan rate, but it has reduced its reserve requirement ratio. So this is the amount of deposits that banks have to keep that they cannot loan out. So if you reduce that, this means that the velocity of money, like so the speed at which banks can make loans, that's expected to increase. And to encourage more lending to SMEs and to encourage consumption. And besides monetary support, on the fiscal front, local governments have expedited infrastructure spending to boost consumption. The current lockdown, has definitely affected consumption, but many economies have expected or will expect consumption to return with vengeance, because there's been unfulfilled demand the last few months that they think will catch up in the next few months as China exits lockdown. Yeah, so that's sort of our macro outlook and backdrop for the next for what's happened so far, but also going forward. And in terms of like where do we go from here? I think overall it has been a difficult time, but for the most part, we do see a lot of like high human cost and inflation because of geopolitical conflict, but economic drivers tend to take over for the longer term. And with that, I will pass it over to Ritesh, who will cover Syfe core and satellite portfolios.
Hey, Grace, thanks for covering that. Very good insights into what's happening in the market and also kind of potential implications coming into the future too. I'll be covering today Syfe core portfolios and the satellite portfolios as well, given that we've recently rebalanced these portfolios to kind of position them in the more kind of strategic manner looking forward. And to that extent, how has these changes, been implemented? That's something that I want to cover. And more importantly, the process that is entailed when it comes to portfolio rebalancing at Syfe. All right, so if we go on to the next slide, let's first look at all the different portfolios and the overall product suite that we have as well, right? So we have our core portfolios. So this is where most of the investors should start investing with Syfe, right? So these are globally diversified portfolios across equities, bonds, gold, and they have different options available for you as well, depending on what your investment time horizon is, what your goal is, what your risk appetite is. So you have options from defensive all the way to equity 100. The defensive portfolio has higher allocation to bonds and gold. So essentially suitable for people who are looking to not take too much risk, but are also okay with lower expected returns. Similarly, as you move forward to balanced growth and equity 100, the proportion of equity keeps on increasing. And given that equity as an asset class is associated with growth, so these portfolios are supposed to grow at a higher clip compared to the more defensive portfolios, but it also comes with higher risk that you're taking. So depending on, again, like if you are having a very long-term time horizon, then people can choose the more growth-oriented portfolios on our platform. Then we have our satellite portfolios. So these portfolios, typically you would layer them on top of your core portfolio. So we typically say that the bulk of your money should be invested into the core. And then if you believe in a certain mega trend or you want to invest according to your own beliefs, that's where you can incorporate thematic investments. Plus, there are also one of the more popular portfolios, the REIT Plus portfolio, which gives you a combination of income plus growth. This is implemented via a partnership with SGX, where we track one of the most popular indices, the REIT indices in Singapore, the IHS REIT Leaders Index, gives a pretty high dividend yield of close to 5%. And given that interest rates are still, pretty low, especially given your savings related interests are still, close to zero, this provides a great means to kind of earn income and dividend in this kind of low interest rate environment. Also, on the thematic side, we have certain portfolios which follow the biggest mega trends that are shaping our future. So ESG and clean energy want to align to your values, the ESG and clean energy principles, then you can look at this portfolio. Or you want to have more targeted exposure to certain segments of the broader investing world, which can potentially shape our future. So healthcare innovation, disruptive technology, these are two key areas where a lot of innovation is happening. Similarly, if you want to take a more active view on the market, vis-a-vis, say, China, where China market as a whole has gone down more than 50% over the last 1 year. But if you feel or if you believe that it's a cyclical trend and eventually the Chinese market will rebound, as I think Grace also alluded earlier, there is a good amount of central bank support that is now coming in on the Chinese side. Yes, there is an ongoing Omicron wave there, but is this something that will persist? And if they are able to contain and then the policy support comes in tandem too. So can that be a story of turnaround for China? So if you have that active view, you can implement it through a ready-made portfolio, which is China growth. And then we have our global income portfolio too. On top of that, we have our custom portfolio builder. This is the first time that you get an instant portfolio builder. So you say that, okay, I want to build my own core portfolio or my own thematic portfolio. Then you can go to our custom portfolio builder and choose from over 100 best-in-class ETFs and construct your own portfolio. We also have our cash management solutions. So if you want to keep your money safe, don't want to take too much risk, but still earn better yield than your bank account, that's where like the cash plus solution makes a lot of sense, gives a projected yield of 1.2%. And the good news is there is no lockup, there is no limits, there is no tiers for you to worry about, right? So very, very liquid, you can withdraw your money at any point of time. We also launched our trading platform. So this was January of this year. And we've heard very good feedback so far. So we continue to give a lot of like free trades as part of the offering. Plus, it is one of the very few platforms in this part of the world that allows you to fractionally invest into the market as well. So this is the overall suite of products. And depending on who you are, if you don't have time, or even if you have time, the convenience that you get with ready-made solutions, you should look at the wealth offerings, which is your core, thematic, custom, cash plus. If you are a DIY investor and want to take away on the market and invest into individual securities, that's where you can use our trade platform as well. If you go on to the next slide, what you will see is how do you invest on a more broader sense, right? So as I said earlier, what we tell most of our clients to do is, given that you are investing for some of your life goals, and that should be the bulk of your investment, you should invest in a more responsible way. And what that means is you should invest in a diversified portfolio across asset class, across geography, across sectors. And that is what you get through our Syfe code. And then you can layer on all of these aspects, whether it is these, technology and disruption related exposures, or any themes that you like, or even if you want to DIY, those should be layerings on top of your core, diversified portfolio. If you go on to the next slide, let's cover a little bit more on the principles that define the core portfolios and the thematic portfolios. What is the approach, right? So the core portfolios are supposed to be broad-based, it's supposed to be diversified. And on top of that, it has our core investment process in terms of building them up, right? So risk budgeting, factor investing, a bit technical, but essentially there is a lot of science behind how these core portfolios are constructed. And this science basically resides with how portfolio construction theory has evolved over multiple decades, right? So we use the same institutional framework when it comes to portfolio construction that any big institution would use, and we are making it available for everyone. Supposed to be diversified across asset classes, geographies, sectors, rebalanced twice a year, and it should be part of your core allocation for an investor as well. Versus the Syfe Select the Themes portfolio, which is part of the satellites. It's supposed to be the approach is to capture the mega trends and the themes, right? So we will continuously evaluate if it is disruptive technology, what are the sub themes that are defining disruptive technology, right? Is it blockchain? Is it artificial intelligence, cloud computing? These are all kind of sub themes within a particular big mega trend. And if you want to effectively capture this particular theme, then you might need to continuously look out for changing aspects of these themes as well. So these portfolios can be concentrated because you are taking a specific view on a certain segment of the investing world. So what it means is they're supposed to be much more riskier, and that's why the allocation to them should also be smaller compared to your more diversified holdings. A rebalancing schedule is same twice a year, and as part of your allocation, it's supposed to be a satellite allocation. Go on to the next slide. Let's take this poll. So which Syfe portfolios do you currently hold? Do they have some options, Jason, or is it a free flow?
It's a free flow, so you can just type in the answer there. So you could have like core, you could have like satellite, and which satellite you could also key it in over there. All right. So I don't see any responses coming in yet, but folks, yes, please join in Syfe Q1 2022. The word cloud is really good. I like this. So we'll get a nice little view as to which are our more popular portfolios.
Okay, definitely equity 100, like a lot of growth oriented investors, I guess. I see some core growth, balanced, satellite ESG. That's interesting. REITs as well. Okay, so yes, looks like equity 100 is the most popular portfolio, but REITs, cash plus, ESG amongst the thematic portfolios also seem popular too. Okay, so let's like dive into the rebalancing aspects of our portfolios, how we actually go about doing this process. So Syfe core portfolio re-optimization. So we just completed this last week. So just cover like how we went about this process, right? So our core portfolios are meant for the diversified, low-cost passive investing. These are implemented using ETFs as building blocks, and these are purpose-built as well. So depending on your specific goals, your specific situation, these core portfolios are personalized. And then for each different risk level that is there, you can choose a portfolio that basically helps you maximize the return for that level of risk. So if you go on to the next slide, it basically shows all of our core portfolios. So a broad level asset allocation. So the defensive is, as you see, much more tilted towards bond and gold, versus the equity 100 is 100% equity portfolio, and also translates into returns. So if you look at the returns, the defensive portfolio has the lowest return, and the equity 100 portfolio has the highest return. But in terms of risk level as well, the core defensive is the least risky portfolio, versus equity 100 has got the highest risk portfolio. If I were to quantify these risk metrics so that it's easier for you to understand what this risk means, equity 100 portfolio, for example, 2020 when the pandemic hit, the markets fell, right? S&P 500, which is the US stock market index, fell by 34%. During that time, our portfolio equity 100 fell close to 26% as well. So because it's a 100% equity portfolio, it can have these big drawdowns. Doesn't happen very often. It happens like once in say 5-10 years. But the important thing is it can happen. So if you are an investor, you invest $100, it suddenly becomes 26, drops by $26, becomes like $74, and you panic and sell, maybe equity 100 is not the right portfolio for you, right? You should choose a portfolio in which you are able to withstand that drawdown period as well, right? So the growth portfolio, for example, dropped only 19% during that period. The balance dropped by around 13%, and defensive dropped by around 9%, right? So yes, the returns are lower, but so is the risk level lower too. And if you are an investor who doesn't have that high risk appetite, you will end up panicking and selling off your portfolios. And those are the worst things to do when it comes to investing, because you are kind of capturing your losses, right? So what we tell most of our clients is to remain invested, remain diversified, choose your portfolio judiciously, and then sort of keep dollar cost averaging over time. If you move on to the next slide. So what's our investment process, right? So it's these three buckets. So the first bucket is portfolio allocation, right? How do we go about allocating these different asset classes in the proportion that are shown there, right? So the general idea is we don't do the traditional, asset allocation process. So what we do instead is we look at each asset class in the form of how much risk are these asset classes contributing to the overall portfolio. And the reason for doing that is because when you look at just asset allocation in isolation, you are basically said that a moderate portfolio should be 60% equity and 40% bond. The fact is, though the asset allocation is 60-40 in favor of equity and bond, the actual risk allocation in your portfolio is very, very different. And I will cover that in the subsequent slides later on. But in our case, the way we construct our portfolio, we look at how much is the risk contribution of equities, how much is the risk contribution of bonds, how much is the risk contribution of commodities and other asset classes. And based on those risk contributions, we combine them in a manner such that, number one, the overall risk of the portfolio can be minimized, but also more importantly, we can achieve the highest possible return from that combination, right? So that's what the asset class risk budgeting, implies. We also then go a step further, because over the last few decades, there have been more research that has been done, and a lot of like active managers, what they claim as their capability to generate alpha It's not really alpha, but it is what is called as smart beta. So factor investing is something that has been in play for a fairly long period of time, but now it has been incorporated in the more sophisticated investment strategies, which then enhances your overall return without increasing, the overall risk of your portfolio. So again, what these factor investing strategies enable you to do is to harvest some of these extra factors that enhance the returns of your portfolio, and at the same time do it in a very systematic manner without taking views in the market. So again, our investment process is grounded in terms of utilizing the best investment approach, which is, again, the science behind the modern portfolio theory. But then we go a step further in incorporating even, factor investing as part of the process. Last but not the least in terms of importance, we re-optimize, we monitor your portfolio on a continuous basis. And the determinant of the portfolio rebalances is not just the portfolio drifts, in the sense that, typically the traditional portfolios are rebalanced when, say, you have a 60-40 portfolio. If it drifts from 60-40 to, say, 50-50, a traditional asset allocation based portfolio manager will just bring it back to 60-40. That's how traditional asset allocation re-optimization, it's just a rebalance, versus in our case, we do a full-fledged re-optimization. And what that means is, as the markets move over time, the expected returns of the underlying asset classes change, their risk contribution changes as well. And if you want to construct a portfolio on an ongoing forward-looking basis that gives you a maximized return for a given level of risk, then you need to rerun that optimization process. And then the combination that comes out will give you the highest possible return on a look forward basis as well. So that is basically a determinant of how re-optimization is taking place at Syfe versus how a traditional asset manager would typically do it. So you go on to the next slide. This basically encapsulates what I was talking to you earlier, right? Typically, you're said that 60-40 is a moderate risk portfolio. What you're not told is, suppose you invest $100 into this 60-40 portfolio, the portfolio for a market correction, say, drops from $100 to $90. What you will realize is most of the times, the $10 drop that you see, almost 9 out of that $10 drop is actually contributed by the stock component, even though stock is only 60% of the portfolio. So even though the allocation is 60%, the risk contribution is more than 90%, versus the bond component only contributes to less than 1% or less than $1 in this case of the drawdown. So the difference here that I want to highlight is, just because you have an asset allocation of 60-40 doesn't mean that your risk allocation is 60-40 as well. It's actually much, much higher, to the extent that it can be 90+% risk allocation to equity and very small allocation to bonds per se. And that's why it is important to have this consideration built into your portfolio construction process. And that's why when I talk about asset class risk budgeting and how, when we construct portfolios, we take these asset classes not just from an asset class perspective, but from the perspective of how much risk are they contributing to the portfolio. So if you go on to the next slide, this basically encapsulates the difference between a traditional asset allocation model, which, as I covered earlier, if it is 60-40, over time, if it shifts to 50-50, the only job that the asset manager does is to bring it back to 60-40, right? And they just keep doing it, periodically over time, without taking into consideration, is the expected return of the underlying assets changes? Are the risks inherent in the underlying asset classes changing or not? And if they are changing, is 60-40 the best combination for you to get the highest possible return for the risk that you're taking, right? And that's what a strategic asset allocation in turn solves for. In our case, we first define what level of risk are you comfortable with. And then based on the risk that you're comfortable with, we try to construct a portfolio that maximizes return for every level of risk, right? And that's what a true institutional asset manager should, envision for their clients as well. So in terms of the actual rebalancing that has taken place last week, if we go on to the next slide, it kind of encapsulates what has happened. Hey, yes. So if you look at the portfolio allocations, the way the allocations have changed before and after the rebalance, mostly for this round of rebalance, the allocations have remained fairly stable. So if you look at the core defensive portfolio, the bond allocation has slightly increased versus the equity allocation, and similarly, the gold allocation is roughly the same range. If you go on to the balanced portfolio, similar trend, I think. The bond allocation slightly increasing, the equity slightly decreasing. So mostly what has happened as part of this rebalance is the price drifts in the market, as well as the factor drifts that have happened in the market from the last round of rebalance that was done in October. The re-optimization exercise has mostly kind of addressed those price drifts. The expected returns of individual asset classes doesn't seem to change materially, and that's why you see a much more kind of stable allocation even after the rebalance for these portfolios. We go on to the growth portfolio. What you see is again the allocation slightly changing to a bit more bond and gold versus previously, equity 100 used to be, sorry, the equity portion used to be more than 70%, so now it is 69.3, but very small changes overall, so pretty stable in terms of before and after the rebalance. If you look at the equity 100, so here we want to show it in a little bit more detail because our equity 100 portfolio incorporates the smart beta elements as well. And it's roughly these three components that define our core equity 100 portfolio, right? So the global exposure. So the global exposure is defined by CSPX, which is your S&P 500. Then you have your small cap and mid cap exposure. And then you have developed markets and emerging markets. So what you see is roughly the allocation is almost similar. The allocation to S&P 500, the CSPX is slightly reduced. Again, some of the other emerging and developed markets is reduced a bit as well. For the smart beta component, so you have RSP, which is the value exposure, QQQ, which is your growth exposure. And then you have some of these sector exposures, which is, say, healthcare, utilities, I think a couple others, which I'm not sure what those stand for. But essentially, more or less stable. QQQ increases from 20 to 21.2%, so slightly increasing, mostly on the back of the recent drawdowns that you've seen in the growth sector. So the price of the growth-related components of the portfolios would have come down. So this re-optimization just kind of brings it back and aligns it back to the broader allocation framework as well. In terms of China, again, the China market has fallen quite a bit over the last 1 year, particularly impacted by the waves of regulatory actions and more recently due to delisting risks and other geopolitical risks as well. And that has led to a lot of price corrections on the Chinese equity markets. And that's why the previous factor ratings, which were close to 13% in equity 100, increases slightly to 16+% as part of the rebalance. But mostly, again, the reason there is this difference being shown is more because the original allocation that China had, because of the corrections, the allocation moved down, and the price drifts related moves translated into only 13% allocation before the rebalance, and the post rebalance, we're basically just bringing it back to even in terms of how it was. So overall, I mean, pretty stable even in equity 100, and mostly looks like price and factor adjustments that has been incorporated. All right, so let's go on to the thematic portfolios. So if you go on, Jason, I think let's look at each of our thematic portfolios. So the first portfolio is our disruptive technology portfolio. And even this portfolio from a return standpoint has been impacted negatively in general, given that the growth sector has been coming off in wake of rising interest rate. But if you look at the components of the disruptive technology portfolio, it basically contains exposure to the future kind of disruptive sectors, right? So whether it is artificial intelligence, cloud computing, cybersecurity, online esports and gaming, or even other sectors such as next generation internet, right? So it gives you a broad-based exposure to some of these more mega trends, the sub-mega trends that potentially can shape our future as well. Now, in terms of the change itself, we had an allocation to IPO previously, So that particular component gave you access to the more recently IPO'd companies. In the recent quarters, what you've seen is the IPO market's been pretty weak, and also in terms of emerging themes within the disruptive technology sector, blockchain is something that has now become much more acceptable as well as prominent in terms of a technology that can potentially shape our future. So we've replaced the IPO ETF with BLOK, and that basically means that our disruptive technology portfolio is now, in my opinion, a bit more geared towards the broader emerging trends within that segment, right? So including blockchain, artificial intelligence, cybersecurity, and next generation internet as well. So we'll continue to monitor the emerging themes within disruptive technology as well. But this is also based on feedback that we've received from you guys. And BLOK is one of the more popular ETFs that we have seen in our custom portfolio offerings as well. If we move on to the next slide, it captures the actual ETFs. So it already described them. We move on to the global income portfolio. Okay, ESG and clean energy. All right, so let's cover ESG and clean energy. So the ESG and clean energy portfolio basically allows you to get a global equity exposure with ESG kind of principles embedded within that. Half of the portfolio gives you the broad-based exposure to, say, US market, developed market, and the emerging markets as well. So 51% is ESGE, ESGU, and ESGD. Which gives you the broad exposure, and these are ESG enhanced in the sense that they will exclude sectors such as defense, such as tobacco and other such segments as well, right? So in terms of ratings and all, they are very highly rated from an ESG standpoint. The other half of the portfolio gives you more dedicated exposure to clean energy. In terms of the changes that we have done to this portfolio, we have removed PBW, which is the clean energy ETF. It was a US specific clean energy ETF. Now in our previous composition, we already had ICLN, which was the global clean energy exposure. So essentially there were a few overlaps that we saw between PBW and ICLN. So essentially we removed PBW and incorporated FAN, which gives you a more dedicated exposure to wind power. And this is, I think, particularly relevant in the current context because wind power is one of the fastest growing clean energy sources in the world. It produces almost 6.2% of all global electricity and represents more than 21.4% of renewable power generation as well. So this, in addition to the fact that if you look at the Biden administration, there are plans to convert miles of the US coastline into offshore wind farms, and that can generate as much as 30 gigawatts of wind energy by 2030, right? And even in terms of the latest kind of omnibus bill that was passed on, the allocation to energy efficiency and renewable energy was at $3.2 billion, which is basically an increase of more than 300 million from the previous round. So again, FAN should give a way for investors to capitalize on the shift towards wind power, right? So, and overall, it kind of completes the overall ESG and clean energy portfolio in a very effective manner. So let's look at the next portfolio. I think the next one just covers these two. Yes, so global income. This has been pretty interesting to look at. The global income portfolio that we've constructed gives you opportunity to invest into global income generating asset classes. Previously, it was only fixed income components that dominated the construction of the global income portfolio. With more research, we have been able to incorporate REITs as part of this offering. So this is basically VNQ gives you US REIT exposure and VNQI gives you, international REITs exposure. Also, I think the most interesting part that I see with this rebalance is the addition of PFFD, which is preferred stocks. Preferred stocks are a different breed of stocks. They give you high dividends, and at the same time, they don't have voting rights, right? So, they compensate you in terms of giving you higher dividends because you don't have voting rights per se. Typically, a lot of banks issue preferred notes, and the yield that you get from these tends to be, 5 to 6% on average. So really helps in the current context of the market where interest rates are rising, but at the same time, like the more traditional asset classes are seeing price corrections happen to them. If you look at the financial sectors, typically the financial sector tends to do well when there is an increase in interest rate, because their net interest margin increases as well. But to incorporate these elements into our global income portfolio, what we also looked at was what is the current composition, and if there were again some overlaps, and if there were ways for us to reduce the duration risk in the portfolios. Those are things that we have incorporated. So HYG is a higher duration portfolio. There is also SHYG, which is a shorter duration exposure to the high yield segment of global income. So we kept SHYG to keep the duration short, and we excluded HYG, which is the higher duration exposure per se. Similarly, the local currency emerging market bonds can have implications when there are rising interest rates. So we excluded that as well to kind of accommodate for the REITs and preferred securities in global income. All right, so if we move on, keep going on. So healthcare innovation and there is, I guess, China growth. These two portfolios, we have not made any changes. The portfolios themselves remain as is. The idea really was to kind of address the price drifts that have happened in these portfolios. And in terms of the underlying themes that we intend to capture through these portfolios, they remain, they remain the same. So basically means that there is no change in the ETFs themselves, both for healthcare innovation as well as China growth. So just adjustments to the weights of these portfolios. All right, so those were the key changes that we have done for both our core portfolios as well as our thematic portfolios. I'll take a pause now. I think like before we go into the custom, and Grace will cover this, some very interesting ETFs being added on our Syfe custom platform. Maybe we open it up for a few questions.
Yes, sure. So I think a lot of our participants want to actually know, in terms of like increasing the bond allocation, what's the rationale behind it?
Right. So look, I think overall it is not that we have increased the bond allocation meaningfully. If you see, the marginal increase in bond allocation is roughly around 1%. It is mainly because of the construction process itself. And what I think it enables to do is, because the equity markets have had a pretty big run till now, the new sort of allocation helps to kind of give you a better risk-adjusted return on a forward-looking basis, right? So that's, I think, what is the reason behind a small increase in the bond allocation. But again, it's not a meaningful increase. So it's not like a big deviation that has happened and a huge shift has happened from equity market to the bond market per se, because we are also conscious, and that process that we have takes that into account, that if you have a very high bond allocation in the current environment, yes, equity markets are coming down, but even bond prices will come down as interest rates increase, right? So overall, I don't think there is any meaningful change. It is just a small, drift adjustments. And again, positioning from an expected return standpoint on a forward-looking basis, the best combination that we can achieve.
Okay, thanks a lot, Ritesh. Another participant actually asked, like in terms of the data wise, if they actually wish to see more data in terms of say 6 months, 3 months, or again comparison against the benchmarks, is there anywhere that they can see this data?
Yeah, absolutely. We are pretty transparent in terms of sharing, not just allocation changes, but even like performance of our portfolios. So you can go on to our website, and for each portfolio, from like the core, the thematic portfolios, there will be a overview page for each portfolio, and then there will be a data page. And within the data page, there will be a past return section. And within that, for each portfolio, the past returns are encapsulated, annualized basis, cumulative basis, in chart format and all as well, and comparing against the relevant benchmarks too. So you can see those aspects pretty clearly. I would, caveat that, look at the longer term returns of the portfolios. There could be short term, overperformance or underperformance, depending on what portfolio you are looking at. But if you look at a longer term time horizon, all of our portfolios are pretty well diversified, and they tend to generate much better risk-adjusted returns compared to the benchmarks per se. I think this was there, even in terms of returns, the 5-year, 8-year returns was shared as one of the slides. So if you can go there, it will show the returns of our portfolios against the benchmarks. Yes, so if you look at, for example, equity 100, over last 5 years, comparing it to MSCI World, so 13.4 versus 13%, and over 8 years, close to 2% more than the benchmark per se. Yeah. So yeah, I mean, like we are pretty transparent. You can look these up even on our websites.
Okay, thanks for Ritesh. I think a lot of our participants also wish to actually go to the start of the presentation where they have more questions about China per se. I think in terms of our outlook for China, should they actually worry about China or worry about investing in China? If let's say their portfolios are currently in the red, should they continue to average or what should they actually be doing with their portfolios?
Sure, Grace, do you want to take that one?
Yeah, sure. Yeah, so I think I'll cover the kind of like outlook for China, but before and Ritesh could probably add on, usually what the advisory team comes in when being asked this question. So to start, I think it is becoming clear that on the economic growth front, right, 5.5% target for this year will be tough. But if you look at like representation of China in a global equity portfolio, right, China contributes about 18% to global GDP based on like purchasing power parity, right? So this is almost 20% if you were to just round it up. And in most like global equity indices and also portfolios, China tends to only have about like 5 to 8%. So in the whole world, I mean, for most investors, they are under allocated to China, based on like market cap type, what counts as the investment universe that's determined by the index provider. But in this case, we do think that China could have, it will still continue to contribute to global GDP. It's showed its resilience during COVID. I know that some companies have been looking to kind of reverse the outsourcing that they've done to China, but if in terms of some of the trends, right, that's happening. So you have like electrification, like clean energy, a lot of the resources that you use, right? So that we'll share a bit later on in one of the new ETFs that we're adding. So a lot of electric vehicles and automobiles, as well as like rare earth metals, that comes from China. And so we feel like, overall, right, China would see some challenges in the short term, but longer term, like given sort of where the world is shifting to, China will still be really important and be very relevant in that scenario. And on the sort of like institutional front, right, so you have monetary policy support, and then you have fiscal as well, right? So in that sense, you have those two cylinders firing at the same time. As there's quite a bit of support and like quite a lot of leeway the government has. I think when we had like an increase in risk of delisting a few weeks ago, right, policy support on that front has also come through. So before that, I think like towards the end of 2021, like around like September, October, we see that even like on gaming, like licenses they stopped issuing licenses, and then now that's started again. And then on the overseas listings, the commissioner has come out and said like, we'll be very supportive. So we do feel like, yeah, don't count China out yet. Like I know it's been very tough, like it's been quite volatile, but yeah, I mean, if you feel like, given the stats that we've seen and some of the data and news coming out, that things are somewhat becoming a bit more optimistic, then yeah, I mean, that could be expressed through your investment views. But of course, I'll leave that to Ritesh to add anything else.
Yeah, no, I think like, look, investing in China comes with its risk, right? So you have to take that into stride. This is not the first time that the Chinese market is down because of regulatory reasons and other reasons that you guys have been seeing as well. But what is more important to note is that targeted policy actions are not new in China. In fact, there is market drawdowns that we have seen almost every year due to some policy action. 17 out of last 20 years, the Chinese market has dropped because of some policy action or other. But the fact is, post these actions, there is also a rebound that you see in these Chinese equity allocations as well. And what that means is, if you can remain invested through these cycles, you should be compensated for that extra risk that you are taking as well. We do, advise clients not to take concentrated positions, but yes, if you see it from a cyclicality standpoint, if you see it from a valuation standpoint, China does look cheap. So there could be an opportunity, but yes, don't over concentrate on one particular asset class just because it is cheap, right? So that's also something that can come bite you back. But overall, yes, investing in China will be risky, but if you hold enough, have a long-term horizon, you should be compensated for that risk in terms of higher returns as well.
Yes, agree.
All right, I think, Jason, let's move on because we are already past time. So maybe, Grace, we quickly cover some of the new additions to our custom portfolios and then wrap it up.
Okay, yeah, sure. Yeah, thank you. Yeah, so for custom, we'll just sort of go right into it. Wanted to say that, custom, it's an instant portfolio builder. So on the app and also on a desktop site, you can choose to put, any ETFs that's on a platform, and you can adjust the allocations, and you'll instantly get the sector breakdown, the country breakdown, as well as you can view past returns. And for each ETF, right, there's an overall risk rating assigned. So as you put together a portfolio, you also get the risk rating for your portfolio. All right, so going into the new ETFs, so to start with commodity and preferreds. Here we have DBB, which is in base metals, and commodities have always, been a resilient asset class during rising inflationary periods. So in recent times, we've seen the prices spiking on worries of supply disruption, and so caused a rally in pretty much all the metals, right? So you have base metals, precious metals, and rare metals and earth metals. So earth metals are things that you use to make magnets, and it used a lot in in the clean energy revolution, like windmills, electric cars, and so on. And DBB invests in futures of base metals. So base metals like aluminum, zinc, and copper. So this is quite different from some other, so we have two precious metals ETFs that invest in gold and silver. So these are done through physical replication, but because base metals, they have a lower value per ounce. So that's not really possible with physical replication to buy, a lot of metals to do that. And so the storage cost would be too high. So in this ETF, it's uses futures. And for rare earth metals, besides like electric cars, guidance systems, iPhones, wind turbines, these are inputs to many of the world's most advanced technologies. And, with the clean energy revolution, global demand has increased in the recent years. So REMX invests in companies. They're involved in producing, refining, and recycling these rare earth and strategic metals. One thing to note is that, these two ETFs, because they're in commodities, and the commodity markets can be quite volatile and occasionally subject to geopolitical risk. Right? So for instance, China accounts for more than 80% of the world's rare earth production, and changes in policies and mining production can have a significant impact on the supply. P2P, yeah, so that was covered a bit earlier during the thematic portfolios. We go to the next slide. So we have 6 new ETFs. They're aimed at responsible investing on this page. Besides the last one, which you've heard of, we have SMOG SMOG, which targets companies enabling a low carbon future. And next, SDG. So these are companies that are aligned with the UN Sustainable Development Goals, which encompass biodiversity, reducing income inequality, and lowering greenhouse gas emissions. So in this one, I want to point out VOTE, VOTE, because that gives you broad-based exposure to US equities. So their pitch is that you get to have a seat at the table to drive positive impact, but you pay passive investment fees, right? Because the expense ratio here is only 5 basis points. So this is quite in line with what you get like BOO and your sort of run-of-the-mill S&P type index like ETF that tracks the
This
index.
is your favorite, right, Grace?
Yeah, this is one of my favorites. Yeah. Yeah, and then
one day
vote,
you own enough of it and get a seat on the table and vote for, like, be an active investor.
Yeah, I think you don't even need to own that much of it. So the company, they own about 0.02% of Exxon stock last year, and they were able to get 3 board seats on the ExxonMobil board. So Vote, they promised to employ similar methods to affect positive change. So there are about 500 over companies, and they would sort of track like how they vote and be very transparent about that, so that you're able to get a seat at the table. Next are somewhat similar, so that's socially responsible investing, but these are exclusion based. So for CAF, like this is Global X, S&P 500 Catholic values, and then the other one, SPYX, it's also S&P 500, but it excludes companies that own fossil fuel reserves. So it's a different way of doing ESG investing. So these kind of exclude what they deem to be bad actors as compared to Vote, which tries to work with them and try to sort of bring them along in the road to like evolution. Lastly, yeah, this is quite interesting because we've sort of comparing to what we've seen on Syfe trade, like Tesla is one of the most traded stocks. This iDrive, so IDRV, it's iShare self-driving electric vehicle and technology. So it's autonomous and electric vehicles. As the world looks to cleaner sources of energy to combat climate change, EVs are rapidly gaining popularity. And this ETF sort of goes beyond just the EV manufacturers. It looks at companies producing batteries and supplying battery materials. As EVs become more mainstream, autonomous vehicles would be the next frontier. So self-driving cars are expected to create about 90 billion worth of opportunities for automakers and technology developers in the next 10 years. Yeah, so I think people are quite aware of Tesla and then Waymo from Alphabet, but I think we will definitely see that pick up even more in the next 5 years or so.